Chipotle reported earnings this week, and the market loved what it saw. Results were really pretty solid across the board. Just continuing momentum at this business. And if you're familiar with Chipotle, if you eat there often, you know why. It's a very efficient business model. They just keep adding stores to the chain. You can slowly raise prices. And if you increase volume even a little bit, your business just does phenomenal long term. It's easy to get to double-digit growth when you have all three of those things working together. So today I want to go through the results, and at the end I'm actually going to give you a stock that I think is a much better growth restaurant with better margins and trading for a lower value. So hold on for that for just a second. But I want to start with Chipotle. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's dig into the results. Here's the quarter release from Chipotle. You can see that total revenue increased 14.1% to $2.7 billion. That's broken up into a couple of different things. Comparable restaurant sales. This is going to be sales at comparable stores. So basically just how is each box doing? Up 7%. Operating margins in each of those stores also increased by nearly a percentage point to 16.3%. So those are both really positive trends. And they opened 47 new restaurants in the quarter, including 43 locations with what they call a Chipotle lane, basically just a drive-through so you can order ahead and they'll just have your food ready for you, hand it to you. This is actually what I've started using a lot at Chipotle. So very convenient way to use their restaurants. A couple of pretty positive trends you can see here: food and beverage and packaging costs. So basically their raw material costs were 28.8% of revenue. That's down 40 basis points or 0.4%. What you're looking for with a lot of these restaurant companies right now is how much price pressure is on their margins. So over the last couple of years, we've seen a lot of different commodity food products go up in cost. In particular, beef, I think, has tripled over the last 5 or so years. That's one of the reasons cheeseburgers have gotten a lot more expensive, which you may have noticed. But it seems like that's starting to subside in certain areas. And so overall, yes, Chipotle is able to increase price a little bit. That should help with margins, but also they're not being overrun by higher commodity costs. So look for that as you look at other restaurant stocks. That helped drive the restaurant level operating margin up almost 2 percentage points to 27.5%. So that's just a phenomenal number for any restaurant. For the outlook for the rest of the year, management expects comparable sales to grow mid to high single digits. Again, that's the kind of growth rate that you would expect from a non-restaurant company, but that is just a phenomenal result, especially given the age of Chipotle. I mean, you would think that their high growth days are behind them, but still growing at a really solid rate. And they're going to add 285 to 315 new restaurants. I was invested in this company back when adding a dozen or so restaurants was a really good year for them. And now they've just expanded that machine to an astronomical level, adding around 300 restaurants this year. So both of those things combined together to give you the growth that Chipotle has seen. And I want to put some of this into historical context. I want to start with the comparable sales numbers. And this is a chart. The column that you see here is the sales per store. So now they're now at $3.1 million in restaurant sales for an average Chipotle store. And then the blue line that you see is the comparable sales per store. So you can see that it kind of jumps around. It was down in 2016. You might remember that's when they went through the E. coli thing. They obviously recovered from that, but it took quite a while to recover. So that reputational hit can really last quite a while. But now it's just been slow and steady growth for Chipotle, now up to $3.1 million, like I said. And that can be one of the main growth drivers for a company like this. But the other big growth driver is simply opening more restaurants. You can see that in late 2019, they had 2,622 restaurants. That is now up to 3,479 restaurants. This does a couple of things for you. It spreads out your operating costs over more restaurants. It gives you more purchasing power. Your growth team is more efficient. So when you're designing new restaurants, you can just go pick off the design from one of the 5 or 10 standard designs you have for a Chipotle and expand in more locations much more efficiently than you could earlier in your growth cycle. So all of these things are working together for Chipotle. Here's the big question for Chipotle that I have is the company's valuation. I'm going to just go through the numbers here. Enterprise value to sales is almost 9. That is a tech type margin for a company that is not a technology company, does not have tech style margins. So very, very expensive stock. Price to earnings multiple on a trailing basis, 68. On a forward basis is 55. So again, very, very expensive stock. So is there a company out there that looks a little bit like Chipotle from an operating perspective, very high margins, very popular restaurant, but maybe is a little bit cheaper and even growing faster? And I have one for you that I'll get to in just a second.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
The stock that I'm referring to is Portillo's. If you are not familiar with Portillo's, this is primarily a Chicago area restaurant. They make beef sandwiches, hot dogs, all kinds of other products, but very, very popular restaurant in that area and now growing into the Sun Belt. Very, very high revenue per restaurant. I believe their average is about $9 million per restaurant, so about triple what a typical Chipotle is making. So a little bit different business model. There is a sit-down aspect. There's a drive-through aspect. Much bigger menu than Chipotle has, but much more revenue coming in per restaurant. And they generate about $2 million in restaurant-level EBITDA, a proxy for cash flow. So like I said, Chipotle generating about $3 million in revenue per restaurant. Portillo's is generating $2 million in EBITDA per restaurant. So the economics per restaurant is just phenomenal, but they only have 85 restaurants. So very, very early on their growth curve. They're not going to be a 3,000 restaurant chain, but they have had their eyes on, they can say potentially get to 900 restaurants. So that's 10x the size that they are today. And if their economics stay the same, this could be a phenomenal stock. Let me give you some of the same multiples. Enterprise value to sales multiple, 2.1. I do want to put the caveat, these numbers typically don't include the portion that is owned by Berkshire Partners. So that multiple is probably more like 2.5 times. Price to earnings multiple on a trailing basis, 38. Forward basis, 29. I'll get to in just a second why that probably underestimates their earnings. But I think this is a better growth restaurant company than Chipotle, and it has better unit economics. It could potentially be much more profitable. Let's go through a quick presentation and just kind of give you an idea of how I'm thinking about this company. This is from a recent presentation to investors, and I think this just shows how phenomenal this business is. $3.5 million in revenue per Portillo's, which is just through the drive-through. Just the drive-through is a bigger business than Chipotle's business on a per restaurant basis. Inside, $4.2 million in revenue. Delivery, $1.2 million in revenue. So each of those could be a phenomenal restaurant, but all three of them are running out of the same restaurant. I talked about obsessed fans. This is one of the things that's hard to get your head around if you don't have Portillo's in your area. But if you have been to one, if you've been to the Chicago area, the lines are insane. I mean, the only place that I have, I'm in the Midwest, the only place that I have around here that would be similar would be a Chick-fil-A, maybe a Culver's, but the lines when you get to lunchtime, or whether you're talking about in the restaurant or in the drive-thru, are just crazy. So very, very popular restaurant. And here we get to the unit economics, like I talked about earlier, $9.1 million in average unit sales. And the restaurant level margin, 24.3%. That's where you get to that, about $2.2 million in restaurant level EBITDA. But they are not particularly profitable, in part because they're pouring money into expanding the business. These are the only states that have a Portillo's right now, is the ones in red. Like I said, I'm in Minnesota. There's only 3 here. There's only 4 in Texas, but they're building a whole bunch in Texas because Texas has one of the restaurants that's doing $19 million in revenue per year. So they're going to be expanding in all of this area, and they're expecting to grow their restaurant count 12 to 15% per year. So that's just the restaurant count. And on top of that, you would have any restaurant level growth. And that's what management is expecting. Unit growth, 12 to 15%, revenue growth, mid-teens, adjusted EBITDA growth, low teens. These are the long-term trends that they're looking for. I think they can outperform on all 3 of these metrics. So if you keep the unit economics high, have very profitable restaurant locations, and you're able to grow them at a rapid rate the way that Chipotle has over the last decade, that's how you get to the Chipotle-like returns. So it's very possible that Portillo's can follow a Chipotle-like playbook by just expanding the number of restaurants and increasing the unit economics of each of those restaurants as they're opened up. And that could generate phenomenal returns. Like I said, the valuation of Portillo's is right around a third to a quarter as cheaper than where Chipotle is trading today. And I think you can make an easy argument that the growth profile for Portillo's is better than Chipotle's long term. So that's why this is the stock that I think investors should keep an eye on. Chipotle's numbers are really, I think, a canary in the coal mine. So if they're doing really well, if they're seeing falling food costs, that's positive for a company like Portillo's. They will report earnings in the next few weeks, and I will be back to let investors know exactly what happened. This is a stock that I own, so very interested in how Portillo's is growing long term. But what do you think about Chipotle's results and my comparison to Portillo's? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.